What if I told you that a decision made by a small group of people, sitting in a room far away, could have a major impact on your savings, your investments, and even your job? That's exactly what the latest Federal Reserve decision means for your finances. In today's video, we're breaking it down in simple terms, so you can understand how this decision directly affects you. Hello, everyone, and welcome back to SmartCoin Chronicles. I'm so glad you're here because today, we're diving into something that could completely change the way you think about money, savings, and investments. The Federal Reserve's latest decision. If you're new here, hit that subscribe button and tap the notification bell so you don't miss any of our weekly breakdowns of what's happening in the world of finance. Now, let's get into it. What exactly is this latest Fed decision all about? And why should you care? What is the Federal Reserve? Before we dive deep, let's quickly recap what the Federal Reserve, the Fed, is. In simple terms, the Fed is the central bank of the United States, and it plays a huge role in shaping the country's economy. One of its biggest tools for managing the economy is adjusting interest rates. The Fed's goal is to make sure the economy grows at a steady pace, without too much inflation or too much unemployment. And the way it does this is by either raising or lowering interest rates. But how does this affect you personally? Let's break it down. What did the Fed just decide? In its most recent meeting, the Fed made a key decision about interest rates. They either raised them, lowered them, or kept them the same. But why does this matter? When the Fed raises interest rates, it becomes more expensive to borrow money. This includes everything from mortgages to car loans to credit cards. On the other hand, when they lower interest rates, borrowing money becomes cheaper. That means, if you have a loan or a mortgage, your interest payments might change depending on the Fed's decision. So, what exactly does this latest Fed decision mean for your finances? Let's take a closer look. Impact on loans and mortgages. If the Fed has raised interest rates, you might see your loan payments go up. This includes home mortgages, auto loans, and credit cards. For example, if you're looking to buy a house, a higher interest rate could make your monthly mortgage payment more expensive. The same goes for any business loans or personal loans you might have. But don't worry, the effect might not be immediate. It usually takes a few months for interest rates to fully filter down into everyday loans. However, if you've been planning on taking out a loan or buying a home, now might be a good time to act before rates go even higher. On the flip side, if the Fed has lowered rates, this could be a great time to borrow money at a lower cost. If you're thinking of refinancing your mortgage or getting a new car loan, you could save money with a lower interest rate. Impact on savings and investments. Next, let's talk about your savings and investments. The Fed's decision can also affect interest rates on things like savings accounts and CD certificates of deposit. If the Fed raises interest rates, you could see better returns on your savings accounts and CDs. On the flip side, if they lower rates, you might not earn as much interest on your savings. When it comes to investments, interest rate changes have a huge impact on the stock market. When interest rates go up, it can make stocks less attractive to investors because the cost of borrowing increases for businesses, and future earnings might take a hit. However, when rates go down, stocks usually get a boost, as businesses can borrow more cheaply and make higher profits. Impact on the job market and the economy. Now, let's talk about the bigger picture. The Fed's decision impacts more than just your personal finances. It affects the economy as a whole. When the Fed raises interest rates, it can slow down economic growth. This is because borrowing becomes more expensive, and people and businesses might spend less. Higher rates can even lead to job cuts, especially in industries like real estate, construction, and manufacturing, where borrowing is key. On the other hand, if the Fed lowers interest rates, it can stimulate economic growth by encouraging borrowing and spending. This can help businesses expand and even create jobs. But it can also lead to higher inflation, which is something the Fed tries to avoid. Why should you care? So, Why should you care about this? Well, the decisions made by the Federal Reserve are crucial because they directly impact your finances. Whether you're saving for retirement, buying a house, or just trying to manage your everyday expenses, understanding how the Fed's decisions affect interest rates can help you make smarter financial decisions. If you're an investor, knowing what the Fed is doing can give you insight into what sectors and stocks might perform well. If you're looking to buy a house, understanding the rate changes can help you lock in a better deal. Alright, that's a wrap for today's video. Now that you know what the latest Federal Reserve decision means for your finances, you're in a much better position to make informed decisions. Whether you're borrowing, saving, or investing, understanding these changes can help you stay ahead of the game. If you found this video helpful, be sure to like it and leave a comment below with your thoughts or questions. Don't forget to subscribe for more insights on the latest economic trends and financial strategies. Thanks for watching SmartCoin Chronicles. Keep learning, keep growing, and stay smart with your money.